2004. At what price it was listed? 332, and now it is at 234. So it has not made anything significantly. Those people who have invested here have not gained anything significantly. Even the money has become lesser if they have got money. Some people claim that okay, this company has given a lot of dividend, so you can see the adjusted prices. So even if you see the adjusted prices, then also you can see it has not gained anything specifically. So you can see Angel One, TTK Prestige, Renuka Sugar, Exide Industries, Sheila Foam, CDSL. These all companies belong to small cap, and these companies are actually largest in their own sector. So size does not matter, quality matters. Sometimes the sector has not grown so much, and therefore the company has also grown to the highest, right? So real multi-baggers are found when the small cap companies, when the company is small cap and it is the market leader of its own sector. So the market size, if the market size is small, it has a lot of potential to grow big. But it should have pricing power. It should have brand value. It should have low debt equity ratio. It should have business for last many years. And we have to segregate and analyze on all these factors as well. So going back to Hindustan Unilever again, and or we can select any company of your choice. We can look at other ratios, which is stock PE ratio, ROC, ROE, and what these ratios mean. So when we say about PE ratio is price is to earnings ratio. So let's say you want to buy a business. You're buying a particular business at 10 lakh rupees. And from that particular business, you have got everything in that, the land, the furniture, everything. And now you're going to earn 1 lakh rupees from this business every year. So after 10 years, your money will get free, right? And after that, you will start, in 10 years, you will recover all the capital you have invested. And after that, you will be earning more on it. Right? And also, it's not necessary that you will be earning 1 lakh only. Currently, you are earning 1 lakh per annum. In future, it may increase also. So you have seen the future prospects of the business also. So when I speak about P ratio, it tells you how much times of its earnings you are ready to pay to the business. So I am paying 10 times. If I am saying the business is of 10 lakhs and you're earning 1 lakh, so you are ready to pay 10 times of its price. And how much here in Hindustan Unilever you are ready to pay? 61 times. Price, you are ready to pay 61 times price of its earnings. Then you have book value. What is book value? Book value is all the assets and liabilities, all the assets less all the liabilities of the company. The valuation would be done at whatever it is shown in the balance sheet. Dividend yield, and there are such more ratios which we need to discuss. Dividend yield. Now when we say dividend yield is exactly how much dividend you have got. Let's say you have got the dividend of 100 rupees. And the face value is 10. So you have generally might have heard, oh my god, they have got the dividend of 100%, 200%, because when the company declares the dividend, company declares it on its face value. So face value is 1. And let's say the dividend is 100. So the company will say we have declared 100 times. But dividend yield is calculated on the basis of market price. So let's say 100 is the dividend and 200 is the market price. So we will say 50% dividend has been granted to the owners, shareholders of the company. Now we hear a lot about ROCE, ROE, and what is the difference between these both? ROCE is return on capital employed and ROE is return on equity. What is the difference? When I say about capital employed, it includes both debt and equity both. When I say equity, it includes only equity. Now you will say, hey, I am an equity owner. Why should I be concerned that how much the debt people have got? Why should we see we all as together? I should see only my return on equity, right? But no, you would be concerned with return on capital employed as well. What's the reason? Return on equity is on your investments, but when we talk about return on capital employed, it will let you know about the overall efficiency of the company. See how ROE would be calculated after deducting interest, after deducting tax, and when you have the last profit after tax. But when you see return on capital employed, we consider EBIT, which is earnings before interest and tax. And that will tell you that how the overall business is performing. Here we can take an example, like see, if you have bought, let's say in this capital there is certain debt, and in this debt you have bought the machinery from debt. Half of the machinery of the business is bought from debt. Now tell me, will that machinery say that I will not perform good because I am bought with the debt people money? No, the machinery is going to perform same whether you have bought that machinery out of debt money or out of equity money, but it will perform same. So, but when you deduct interest, if you see that calculation which we do when we do EBIT minus interest minus taxation, and then we get profit after tax, in that calculation debt is at fixed rate of interest, so the efficiency of the company is much more reflected when you calculate ROCE. But when you do it in the cases of banks or in the cases of finance companies, so there will be a different procedure that we will learn in another video, because for them this will be different, because for them debt, if we call it as debt, even their debt to equity ratio will also not work. Because for Hindustan Unilever, you will say, oh, it has taken debt. Oh, this is because you judge the company. बहुत ज़्यादा debt है. Why the debt is more? But you know, in case of banks, taking debt, taking loan and giving loans, that is their main business. So for them, we don't see debt equity ratio. In normal companies, like this is FMCG company, so in all other companies other than banks and financial companies, NBFCs, we consider debt equity ratio. Generally, for new investors, beginners, we recommend that the debt equity ratio should be less than 0.20. What is debt equity ratio? It tells you how much is debt and how much is equity. For example, here in Hindustan Unilever, it is 0.02. So if the company has total capital of 100, the debt portion is only 2%. And then we have a lot many ratios, EV, EBITDA. For that, we have to go into more technicals, pledged percentage, and price to book value. And we will discuss each ratio in more videos. Now, discussing in general, this is the chart. But for technical analysis, better go to trading view and see the chart in more details. Even you have pros and cons of the company, like you can see it is debt free, ROE is 3 years, track record, it is good. Company has been maintaining a healthy payout ratio, but stock is trading 12 times of its book value. Promoter holding is also decreased. So in all the stocks, you will have some pros and some cons. Also, you can do peer comparison, like I told you in fundamental analysis. What you can do is, who are peers? Peers are in terms of market capitalization, they are the companies of your level, right? Almost your level, but they belong to your same sector. So if you see Hindustan Unilever, PNG Hygiene, they are kind of the businesses having the same business model. So you can check that this has 61p, Whereas if you see Colgate, it has 45p. If you see P&G Hygiene, it has 82p. So you can compare here. Okay, Hindustan Unilever is doing the sales per quarterly of 15,215 crores and generating quarterly profit of 2601 crores. But if you see P&G Hygiene is generating the profit of only 165 crores. Comparatively, it is a very small company, but the PE is very high. So you can compare accordingly with its peers. Then you have quarterly profits, quarterly P&L statements. So here you can every quarter whenever the results come, whatever the recent results are there, you get it here and you can compare what is the operating profit, whether the company has been growing consistently or not. Generally, like we have selected FMCG. So you see the companies keep on growing but not very fast, but they grow in a slow paced manner. All right, here you have profit and loss account yearly. So we can compare from 2012, the company has grown almost more than 2 times till today. And there are various so many detailed factors. If you're selecting a company, once it is selected, then I'll consider everything: interest, depreciation, what is the EPS. In banks, then there are NPAs, and there are much more factors. Now the EPS has increased from 12 to 43. So the company is taking care good of its stock stakeholders, of its shareholders. What is the compounded profit growth? What is the stock price CAGR? If you would have bought this company's stock, how much CAGR would it has given you? How much return on equity it is giving? And when you come to balance sheet, you have certain factors you can compare. The share capital, this is the basic share capital. Reserves, if you can see the company has its own money 3000 crores in March 12, and now it has grown to 50,000 crores. So the company has grown more than 12 to 13 times in terms of its own reserves. And if you see borrowings, okay, 1200 crore borrowing is too much? No, it's not too much because they have their own money. 50,000 are own reserves. So 1200 borrowings are not too much. That much so they might be having available in cash. If you see cash and cash equivalents are 4, 6, 7, 8 crore. So this much borrowings is nothing. You can see in detail, like you see fixed assets. Now here you can see suddenly you can see here there is a lot of increase. So people can someone might think that 5,000 crores fixed assets has grown to 51,000 crores. So the company has made its expansion, made its machineries 10 times. So now the profit will also be 10 times. No, it was not. It is in this quarter what happened. Yes, here this is intangible asset. So what happened exactly in Hindustan Unilever case, if you see the brands of the company has all these brands. Yes, company has bought Horlicks. So Horlicks was initially the brand of Dabur India, but Hindustan Unilever has bought Horlicks from them. So, actually, if you see the market capitalization is very less of this company. If you see, that means each and every brand, this company has how many brands? This company has, let's say, I think more than 200 brands. So, each and every brand, when you're purchasing a brand, you're reporting in your balance sheet. But those brands which you have your own, for them, you are not reporting. So they have 200 brands. So you can imagine what is the worth of the company. When they are buying a brand from someone, they are paying 40,000 crores, 45,000 crores just for one brand, Horlicks. Now Horlicks has a much more variants. So you have other inventories, you have cash flows. Now in cash flows, it is very important to understand that operating, investing, and financing activities. So obviously these are going to be in negative because you're putting your money, but make sure that the cash from operating activity has to be positive, and not only positive, but also it should be at least like the profit from the business is how much, 10,000 crores. So company should get in cash whatever they have earned, that the company should get in also. Because let's take the example of Gitanjali. So if you see this company, now it is delisted, and in this company what happened was, if you see March 14, all right, so when you see March 14, you can see the company has how much profits? The profits of 36 crores. Suddenly from 595 crores, they have profit of 36 crores. But well, they have profit of 36 crores. But is this profit coming in the cash flow statement? Let's check the cash flow statement. So in cash flow statement, you can see instead of 36 crores coming, there is 2966 crores going out. Right? Because what they are showing is, they are showing that their receivables, they have done sales, but the receivables have not given them money. And payables also they are showing in negative. That means they are showing that they have paid in advance to their creditors. So such things also happen. And yeah, so it is very necessary for us to make sure that what is coming in cash. And when we come to ratios, so let me come back to Hindustan Unilever. You can see ratios, they have cash conversion cycle negative, they have working capital days also negative. We'll study ratios in depth in some another video. But for here, you can see the debtor days. Debtor days is how many days when I'm selling a particular product, in how many days my debtor gives me money. So that debtor gives them money in around 17, 11, 14 days. Inventory days is something when I have bought an inventory, in how many days it gets sold. Like my cash is converted, when you're buying something, your cash is converted into inventory. So that inventory, at what date it is getting sold. So that is around 59 days. Days payable, in how many days you have to turn around, you have to pay to your creditors. So see, that's too high. Because of that cash conversion cycle, it is said that the lower the cash conversion cycle, better it is, because it is a cycle that is the time your cash is taking to get back converted to cash. Because what happens is, cash get converted when you buy something, cash is converted into goods. Now when you sell these goods are converted into debtors. Now when these debtors give you money, this gets converted into cash again. So this is a whole cycle. Here this cycle is negative. That means they are not even putting their own money in working capital. Working capital is financed by others. So this is very good in here, and that's why you can see ROC is so high in terms of current capital. And then lastly, you have shareholding pattern, where you can see that who is holding the shares of the company. These are all the promoters who are holding the shares. These are FIIs who are holding the shares. In FIIs, we have Government of Singapore, DIIs, and you have some percentages owned by government. Public is owning good 12%, and in public also there are names of certain people. So the people who own more than 1%, their name appears here. So you know what we believe is, the more, because if I have, you can do it yearly also. If I have trust on my company, why will I dilute my share? I'll try to have the maximum share with me. So the more the promoter holding, even the promoters sometimes come here, FII, DIS, and the promoters come in public also. But the more the promoter share, it is better for the company. In government companies, obviously the scene is different and there are more details to it. Here it is all about documents. So all the documents of the company, you can get these documents from the annual report also, but you can get these documents, you can get the annual report from here. Even all the quarterly publishes, you can get it from here, where there was profit and loss account statement. This is profit and loss quarterly, so from here you can get the quarterly publishes also, and this will tell you all the details about the annual report, or the, and it has various links also which you can click and get more details about the company. So this was it for today. We will understand more aspects of it in more detail in another video. Thank you so much.